The Federal Reserve is one of the most powerful institutions on Earth. It influences the strength of the dollar, controls interest rates, and has the power to make or break markets with a single announcement. To most people, the Fed is a mysterious force operating quietly in the background of our lives. But behind the official statements and complex economic jargon lies a reality most Americans never truly see. The biggest secret of the Federal Reserve is not just how it works, but who it works for, and the impact of its hidden hand on your everyday life. Today, we'll take a journey through the history, the mechanics, and the controversies of the Federal Reserve, exposing what may be the most closely guarded truths in the financial world. The story begins in the early 1900s, a period marked by financial instability. The Panic of 1907 nearly brought down the American banking system, and politicians faced enormous pressure to create a central authority to stabilize money and credit. The way this system came about is where the first layer of secrecy begins. In November 1910, a small group of bankers and politicians boarded a private train under false names and traveled to Jekyll Island, an exclusive retreat off the coast of Georgia. There, in absolute secrecy, they crafted the blueprint for what would become the Federal Reserve. This meeting wasn't democratic or transparent. It was engineered by powerful men who wanted to protect both their fortunes and the system that made them rich. When Congress eventually passed the Federal Reserve Act in 1913, few Americans realized just how much control private bankers had already embedded into the new institution. Most people assume the Federal Reserve is part of the U.S. government, operating like any other federal agency. That assumption is wrong. The Fed is a hybrid, a strange creature that is part public and part private. On the public side, the Board of Governors in Washington, D.C. is made up of officials appointed by the President and confirmed by the Senate. This structure gives the illusion of accountability. But on the private side are the 12 regional Federal Reserve banks spread across the country, each one owned by private member banks. These banks hold stock in their regional Fed branches and, by law, receive guaranteed dividends. Imagine that. Banks own shares in the very institution that regulates them. This dual structure means the Fed is not truly a government agency, nor is it a typical private company. It exists in a gray zone where private interests and public policy intertwine. So what does this mean in practice? It means that the people who benefit most from the Fed's actions are not ordinary citizens, but the financial elite. Every time the government issues debt, it sells treasury bonds. The Fed buys these bonds, earning interest in the process. While it does return most of its profits to the U.S. Treasury, the system ensures that member banks enjoy guaranteed payouts no matter what. And even more important, the Fed acts as a safety net for the banking system itself. If the financial world collapses, the Fed steps in, not primarily to save workers, homeowners, or small businesses, but to save the banks that form its foundation. The mechanism of money creation is another part of the Fed's secret. Most Americans imagine the government prints money and the Fed simply manages it. But the truth is more unsettling. The Fed has the power to create money digitally, literally out of nothing. When it buys securities, issues loans to banks, or injects liquidity into the system, it does so with newly created dollars. Economists call this process monetary policy or quantitative easing, but at its core, it is money conjured from thin air. This ability allows the Fed to pump trillions into the economy during crises. But here's the catch. The effects are not felt equally. When the Fed injects liquidity, asset prices like stocks and real estate tend to surge. That's great for the wealthy who already own these assets. But for the average worker living paycheck to paycheck, the result is inflation. Higher grocery bills, rising rent, and shrinking purchasing power. Inflation is the invisible tax the Fed rarely admits to. When more money is created, the value of existing dollars declines. You may not notice it right away, but slowly, that dollar in your wallet buys less and less. While the government may not raise your official tax rate, inflation quietly eats away at your earnings and savings. This is why so many people feel like they're running on a treadmill, working harder but never getting ahead. The Fed insists it targets price stability. But in reality, even low levels of annual inflation compound over time, transferring wealth from savers to debtors and punishing those without significant assets. The Fed's role in financial crises is equally controversial. During the Great Depression of the 1930s, critics argue that the Fed's failure to provide enough liquidity made the downturn worse. Decades later, in 2008, the world witnessed the collapse of major financial institutions as the housing bubble burst. The Fed responded with unprecedented bailouts, lending trillions to banks and financial firms. The justification was that saving the system would prevent a complete collapse. But ordinary Americans lost homes, jobs, and retirement savings, while the very institutions that caused the crisis were rescued. Then came the COVID-19 pandemic. Once again, the Fed unleashed trillions of dollars into the financial system, buying corporate bonds and stabilizing markets. Stocks soared, billionaires grew richer, and yet millions of families struggled to pay rent or put food on the table. This raises an uncomfortable question. Does the Fed stabilize the economy, or does it simply protect the financial elite? Supporters argue that without the Federal Reserve, crises would spiral out of control. Critics counter that the Fed creates bubbles by keeping interest rates artificially low, encouraging reckless borrowing, and then stepping in to rescue those who take the biggest risks. In this view, the Fed is less a firefighter and more an arsonist who extinguishes the very fires it helped ignite. The official mission of the Fed is known as the dual mandate: maximize employment and keep prices stable. But in reality, there is a third, unwritten mandate: protect the banking system at all costs. This explains why banks receive bailouts while ordinary citizens receive much less direct support. It also explains why Fed policy often prioritizes stabilizing markets over addressing inequality. When markets wobble, the Fed acts swiftly. When families struggle with stagnant wages or rising costs, its response is slower, less direct, and often filtered through the financial system rather than targeted at individuals. The influence of the Federal Reserve doesn't stop at America's borders. Because the US dollar is the world's reserve currency, the Fed's actions ripple across the globe. When the Fed raises interest rates, borrowing costs soar for countries holding dollar-denominated debt, leading to economic crises in emerging markets. When the Fed floods the world with cheap dollars, global inflation rises, hitting vulnerable populations hardest. In other words, the Fed's decisions don't just shape the US economy, they shape the world economy. Understanding the Fed matters because it affects you in ways you may not realize. The interest rate on your mortgage, the credit card debt you carry, the job market you rely on, even the price of your groceries. These are all influenced by decisions made in closed-door meetings at the Federal Reserve. Yet the institution is cloaked in complexity and secrecy. It uses economic jargon that makes ordinary people tune out, and it operates independently of direct political oversight. This independence is sold as a safeguard against short-term politics, but in practice, it allows a small group of unelected officials to make decisions that shape the destiny of millions. And that brings us back to the biggest secret of all. The Federal Reserve is not simply a neutral referee balancing the economy. It is a power structure designed to maintain the stability of the banking system above all else. Its hybrid nature keeps it beyond the full control of either the people or the government. Its policies enrich those who already own assets while quietly taxing those who don't through inflation. And its global reach ensures that its decisions, made in Washington, ripple into every corner of the world. So the next time you hear about the Fed raising rates, cutting them, or launching a new round of bond purchases, remember, these moves are not just technical adjustments. They are decisions that redistribute wealth, determine who suffers in a downturn, and shape the economic landscape of the future. The Federal Reserve may not wear a crown or command an army, but make no mistake, it is one of the most powerful forces in the modern world. The question you need to ask yourself is simple. Is the Federal Reserve really serving the people, or is it serving itself? Is it the guardian of stability, or the grand manipulator hiding in plain sight? If you found this video eye-opening, hit that like button, subscribe for more financial deep dives, and share your thoughts in the comments below. Do you believe the Fed is protecting us or protecting the very system that keeps us in debt? Your voice matters, and the more we question, the closer we get to uncovering the truth.